Welcome to the latest in my probably far too infrequent little market wraps. Let me know in the comments section whether you'd like these to be on a more regular basis and more formalised. This is a fairly commodities heavy edition of Market Wrap, but before I get on to the commodities that I'm interested in, there's one or two, let's say, global points I want to make about markets in general. This is the S&P 500. One of the issues that people have in trading is new traders have this constant belief that the moment they enter the market will crash. And that seems to be a persistent fear, particularly when you've had markets that have done very well for extended periods of time. One of the things that I frequently say to new traders is the market will tell you everything you need to know. And if we go back to previous crashes, if we go back to the likes of 87, the market warned you in advance that that was occurring. This is a daily chart of the S&P 500. And so we ask a simple question. And most problems in trading can be answered by asking simple questions. Is there more green than red on the screen? If the answer is yes, then you are a buyer. This is a daily chart of the S&P 500. And you can see from November of last year, it has trended very strongly. It's also had several gaps. Gaps are a very powerful trading signal. But again, the point you have to be aware of is looking at this and looking at its longer term version, and this is a weekly chart, and assuming instantly that because a market has gone up, it must crash. Granted, all booms end in busts, but you are warned about the bust in advance. And this seems to be very, very much a talking point at present, and it has infected a lot of the commentary that I've seen. And you will see variations of graphs like this, and I use this, but these are only useful in their extremes. In the mid-range, they are useless. They tell you nothing, and they tell you nothing because of the structure of an index. This is simply the percentage of stocks above a 200-period moving average, and this is a weekly chart, because I want a very broad global perspective. From the perspective of a portfolio trader, I'm not interested in the day-to-day movements of this sort of tool. And you will see many sites will have a variation of this. They'll have a number of stocks above a 5-period moving average, a 10, a 15, a 20. And everybody goes a little bit twiddly in their nether regions when they see these, and they instantly think the market's coming apart. What this is telling me at present is that within the S&P 500, there are 64% of stocks, or thereabouts, above this moving average. So what does that tell me? Nothing. Doesn't tell me a thing. And it doesn't tell me anything because the way indices are structured. These indices are weighted. So a simple count like this in the mid-range and not at the extremes is useless. It doesn't tell me anything that I can use at all. Much has been made of this, and this chart and variations of it went around the market last year. And it does make a very valid point. The market in the US is very concentrated at present, and the bulk of returns from the index last year came from a handful of stocks. The point I will make is, if I'm a daily trader of the S&P 500, I don't care where the gains come from. I don't care whether they come from one stock, 10 stocks, 100, 200. I'm not interested. All I'm interested in is the index going up. And all this tells me is that there were tremendous opportunities in these particular stocks last year. And some of these continued on into this year. When I was preparing this, I looked at the S&P 500 and the current year-to-date change of a series of stocks. And these are the leaders that I found. And there are some names you will recognise, some you will not. doesn't really matter. What I've also done is I've looked up their weighting within the S&P 500 just to have a look and see what it is. And all of a sudden you can start to see that whilst SMCI has had 198% for the year, its weighting within the index is very small. Nvidia, 6.79%. Most of these are quite small. But again, I come back to the point. It doesn't matter where the drivers come from, provided the index is going up. And you can see that even though these names are not contained in this particular chart, they've still generated extreme returns for the year to date. These are very good. These are very powerful returns. And yes, the dominance of a handful of stocks continues. And these are all big names. But we flip back to a very simple question. And the simple question is this: is there more green than red? If there is, I'm a buyer. That's just the way it is. I'm not concerned about a crash. I'm not worried about what might happen. I do see a lot of variations of this particular chart appearing on social media with all sorts of lines drawn on the extreme right-hand side of where the market is going. To be blunt, the people who generate those charts are profoundly delusional as to their predictive ability. They have none, you have none, I have none. That's the really good part about markets, because if markets were predictable, risk would disappear. If risk disappears, reward disappears. So when you see a chart like this, and the right-hand side is filled in with all sorts of arrows and lines and waves and other technical masturbation, you can be certain that the person who has drawn it has no friggin' idea what they're doing and no idea what will happen. But that's not a bad thing. So that's the global view over and done with. This is our local market, the S&P ASX 200. And as you can see, once again, we are bouncing along in this channel that we've had since about April. And if we scan out, we can see that it's part of a larger complex that dates back 3 years. The market has had various perturbations, but in essence has largely gone sideways in a range. That's not as bad as it seems. It is frustrating, and I will make the point again that I believe that the local market is a special situations market and has to be treated as such. But there are some positive lights, and positive lights came towards the end of last week in commodities markets, particularly in the metals. This is taken from finviz.com. It's a free site you can visit. Don't have to pay a thing. And I've cut and pasted this simply because it gives a very quick indication of what happened with precious metals towards the end of last week. And as you can see, they're all very positive. And that all of a sudden opens up opportunities. However, I will introduce a caveat, and I'll reinforce the caveat at the end. The opportunities only exist for the patient. Markets have no tolerance for people who are impatient. So if we look at gold to start with, I scanned through a list of about 203 gold stocks and then ranked them in terms of their percentage price change from the last session. And as you can see, there's some very impressive gains. But there is an immense caveat in this, and there's a very large problem, which is why I've included the column for market cap. These stocks are rubbish. There's really only until you get to Chalice Mining that you're starting to talk about grown-up money. Peak Minerals, with a market cap of $5.21 million, would not buy you a decent house in the inner east of Sydney. These are all tiny stocks. As such, they are fertile ground for pump and dumps, fertile ground for scams. They are very difficult to trade. It was only until I got down to number 39 in my list that we started to come across serious size in terms of market cap. So we have to try and thread this needle of often small market caps and opportunity, and we have to try and somehow work out how we match those two together. And I have spoken about this before in a previous video on how we actually select stocks. Market cap is an important component if you do not wish to be caught in rubbish. In terms of looking at stocks, what I've done is I've selected those that present opportunities in terms of a price point they need to move beyond. So this is Genesis, and we can see it's stuck at around the $2 mark. For me, a breach of $2 is a buy, although it does have that very, very uncomfortable looking candle. This interests me, and it interests me because of simple technical analysis. A point that traders often forget is that the most valuable thing they are seeing is a blank chart with just price on it. The moment you begin to plaster a chart with indicators, tools, ideas, bibs and bobs, you're beginning to move away from the purity of what price is telling you. You'll notice in this we have two gaps. There is a gap in February 2023. There's a further gap in August 23. Both of those have been filled, and I've highlighted the point before the gap in Feb as we were rolling into 2023. This gives me a benchmark. Whenever a gap is filled and filled strongly, it is a powerful signal in the opposite direction. So if you've got a bearish gap and that is filled by price moving back up and is filled strongly, the market is telling you something. Again, we come back to this notion that the market will tell you everything you need to know. You just have to listen. And we can see the work that the stock has done to move beyond those particular gaps. This is more speculative than something like Genesis at $2, because we're looking at a stock where we really need a punch beyond 12 to be interested. Catalyst is the same in that it is given as a benchmark, and the benchmark is the $1.20 region. We move beyond that, and all of a sudden it gets interesting with the next possible line of resistance, about 145, 150. Resolute is an old favourite of the market, and as you can see, has been a very poor performer throughout 2021. A little bit of life in 23, then sideways, but now we have this very strong candle, which is a breakthrough candle. It's not a breakout. There is a difference. There is a horrible tendency of traders to go on breakthroughs, and they get caught by false breaks. For me, I would want something confirming this move beyond the high of the previous candle. So effectively, I would like movement beyond 60 and movement beyond 60 on volume. The other metal that was of interest in that little snip I showed earlier was platinum. And again, I've picked those instruments that present an opportunity for the patient. This is Perseus, and we can see that we have this resistance in the low 250 mark. And it's banged up against that a few times and failed. So we had this notion of a trigger point, a point whereby if price moves beyond, we all of a sudden shift to a different mode of action. The other one's copper, be it copper or high-grade copper. This is actually a chart of high-grade copper, and this is a daily chart. You can see that movement up late in the week, and it's a very strong movement up. There is a lot of fundamental stuff bumming around the internet, apparently about a worldwide copper shortage. No idea. But what is important to me is that the price has begun to move, and it's important to me because I trade the underlying commodity. In terms of opportunities, this is Aurelia, but one of the things we have to be careful of here in Australia is it used to be somewhat easier to delineate stocks that were pure plays in certain commodities. And I did see the somewhat ridiculous statement the other day that all you had to do was to look at the underlying price of gold and then buy any gold stock. That's no longer the slam dunk it used to be. That used to be a viable strategy decades ago, before producers became more sophisticated and forward sell. They do so for the simple economic reason that it evens out cash flow. So in an ideal world, what you would do is see the price of gold move and then find an unhedged producer or explorer. Difficult to do because most are sophisticated. I picked Aurelia out of my bunch simply because we have this point of resistance at 21. So a movement above 21, again, is a signal to take action. But it is the movement above 21 that is the signal to take action. That's the important point. There is also a commodity that's not very glamorous, where there's been some movement in the underlying stocks, which intrigues me because the commodity itself has not done anything dramatically interesting. And this is Whitehaven coal, which I should mention is an old favourite of mine and has been for years simply because of its capacity to trend. You can see that very strong candle for the previous week. I was curious to see whether this was somewhat of a systemic effect and affected other similar stocks. And this is Yan Coal, and it's showing something similar. You'll notice, though, that Yan seems to be a little bit noisier than Whitehaven. The other commodity of interest to me is crude oil. And the point about commodities is that if you cannot trade the commodity, or you're reticent to because of inexperience, and I will point out that there is no difference to trading a commodity than to trading a share. Yes, I understand people will tell you that you need specialist knowledge and specialist trading techniques and specialist tools. My simple response to that is bullshit. It's not true. Trade one, trade all. It's as simple as that. But if you can't, if you're reticent to do so, if you feel your inexperience prevents you from doing so, then we search for analogues. So if you look at the price of crude, this is West Texas, and we can see that crude has been banding for a good year and a bit, with this resistance at just below 90. So we would need an analogue to trade this, something that looked like this. This is Santos, which does bear a resemblance in terms of the pattern from 2020 to crude itself. Santos is a useful analogue for those who are looking for more, I'll use the expression, portfolio plays. It's not speculative, it gives you exposure to the underlying. The issue here, though, is that changes in the underlying might not translate completely to changes in something like Santos. So we look further afield and we look for something that is more speculative. This is Cooper Energy, and again, we have this banding where a breach above 24 is our signal to go. The same is true with Horizon, whereby we want to be above 19 and go. One of the things to note about stocks like this, though, and you'll see this as a function of the way the particular candlesticks look in these stocks, price discovery is often poor. This is something you need to be aware of, and you need to adapt your trading or investing to reflect that. You will get these periods where you get very strange looking candles that are really just sticks. And that's a lack of price discovery. Ideally, you want to see a change from this sort of very odd-looking, almost hatchet-like series of candles to what you'd expect of something that had a great deal of volume in it. But that's not to dissuade people from taking these as opportunities. In terms of pure commodity plays, moving away from underlying stocks, the only one, there's two that I'm primed to look at for this week. Cotton is a commodity I've already been short this year. this is a secondary move for it. You can see that little box that I put down there. I would require a break below that to be interested. Part of people's reticence to trade something like this is they look at it and say, well, it's come down from 100, 105 to 71. Yes, that's true. But a lesson I learned a very long time ago was that markets will move much further than I could ever imagine. And so you have to be aware of your perceptions of how far something will go are largely irrelevant. The second and final one I'm looking at this week, and you'll note this is a 4-hour chart, this is not a daily chart, is New York Cotton. But I have a concern, and the concern is those two particular candles at the extreme right. I'm not a fan of these artificial trading sessions that CFD providers put in. So I'm at this stage not convinced that that is a true gap. I am wondering whether that is a system gap, an artifact. But only time will tell. Only a true trading session opening in the US market on our Monday night will actually tell me whether that is true and whether I can act upon it. And so if there were a theme for this particular market wrap, it would simply be this: patience is free. Patience doesn't cost you anything. Impatience costs you a great deal in markets.